Happy Thursday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. My vacation is over. I'm no longer in Bali. I am actually now in Tokyo, but on business, not leisure. There's a lot to cover, so let's jump in. And first up, a sudden military flare-up between nuclear-armed rivals India and Pakistan is raising alarm across global markets and intensifying fears of economic destabilization in a region already under pressure from inflation, slow growth, and fragile geopolitical balances. The recent escalations began after a deadly April 22nd militant attack in India-administered Kashmir, which killed 26 civilians. India blamed Pakistan for harboring the attackers, a charge Islamabad denies, and responded with unprecedented airstrikes on what it called, quote, terror camps, end quote, deep inside Pakistani territory. Pakistan retaliated by claiming it had shot down 5 Indian military jets and 1 drone. Its military was authorized to respond, quote, at a time, place, and manner of its choosing, end quote, according to a statement from Prime Minister Sharif's office. While both sides have so far stopped short of full-scale war, the intensification of cross-border hostilities has already had financial ripple effects. The most immediate economic risk is the possibility of prolonged instability, deterring investment across South Asia. Both India and Pakistan are navigating delicate post-pandemic recoveries. Pakistan in particular remains heavily reliant on IMF financing, with its foreign exchange reserves still under pressure. Quote, you can appreciate the pressure that we're under, end quote, Pakistan's finance minister said yesterday, adding, quote, 2 nuclear-armed nations, simply no one can afford to go in a direction where escalation takes us into uncharted territory, end quote. An open conflict would further strain Pakistan's already struggling economy, potentially derailing reform efforts, weakening the currency and worsening inflation. The IMF has urged Pakistan to curb defense spending and broaden its tax base, goals that would be politically impossible during a military escalation. For India, which is predicted to be the world's fastest growing major economy this year, conflict brings its own complexities. New Delhi has tried to present itself as a global manufacturing and investment hub, an ambition that relies on regional stability. The resumption of hostilities near the line of control and India's decision to suspend a water-sharing treaty under the Indus Waters Agreement not only raises environmental and agricultural concerns, but also signals a strategic hardening that could unsettle foreign investors. This complicates things for multinationals, which, due to the global trade reset, had eyed India as an alternative to manufacturing in China. The international response has been cautious. US President Donald Trump said he hopes the tit-for-tat exchange ends quickly, while Secretary of State Marco Rubio said Washington is closely monitoring the situation. Despite good relations with both countries, the US has limited leverage to prevent escalation beyond offering mediation. A drawn-out conflict could disrupt trade routes and spill over into broader regional insecurity, with implications for Afghanistan, Iran, and China's Belt and Road projects, particularly the China-Pakistan Economic Corridor, CPEC, which passes through areas close to the conflict zone. The crisis also detracts from broader regional economic goals. South Asia's growth potential is often hobbled by border disputes and political rivalry. While ASEAN, the Association of Southeast Asian Nations, have moved toward regional integration and supply chain cooperation, South Asia continues to be divided, and conflict like this only deepens that fragmentation. Both nations possess roughly 160 to 170 nuclear warheads, according to the Arms Control Association. Although both sides have historically shown restraint since becoming nuclear powers in 1998, the risk of miscalculation remains significant. Any escalation into nuclear confrontation would carry catastrophic economic costs, not just for South Asia, but for global stability and markets generally. And of course, the human cost is almost too terrifying to quantify. Next up, in the US, Federal Reserve Chair Jerome Powell said yesterday, the central bank is in no rush to adjust interest rates as it monitors the potential economic fallout from President Donald Trump's sweeping tariff policies. The Fed unanimously voted to leave the benchmark's federal funds rate unchanged in a range of 4.25% through 4.5%, a level it has maintained since December of last year. At the conclusion of the 2-day Federal Open Market Committee (FOMC) meeting in Washington, Powell emphasized the rising uncertainty clouding the U.S. economic outlook. Quote, if the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment, end quote, Powell said. While the Fed continues to aim for both price stability and maximum employment, those twin mandates may increasingly come into conflict. Powell acknowledged that the inflationary effects of tariffs could be short-lived, reflecting a one-time rise in prices, but warned they might also prove, quote, more persistent, end quote. The Fed's statement flagged that, quote, uncertainty about the economic outlook has increased further, end quote, and highlighted growing risks of both higher inflation and rising joblessness. This cautious stance was reinforced by Powell's comment that the cost of waiting before making policy changes remains low. Quote, we think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient, end quote, he said. Trump's tariff regime, which targets a wide array of imports and is part of his broader America First economic strategy, has raised alarm among some economists. Many anticipate that the levies will stoke inflation while weighing on growth, creating a stagflationary scenario marked by slow economic expansion and rising prices. That poses a unique challenge for monetary policymakers. Others push back, however, saying that the pain will be short-term and the economic benefits for the economy over the medium to long run will make the short-term pain worth it. Of course, only time will tell which camp is correct. Despite the US President's public pressure on the Fed to lower borrowing costs, Powell and other officials have pushed back on calls for preemptive easing. Economic data so far has been mixed. While the US economy contracted earlier this year for the first time since 2022, underlying demand appears resilient. A sharp increase in imports ahead of tariff implementation and a surge in consumer spending in March suggest businesses and households are attempting to front-load purchases. The labor market also remains solid, with 177,000 jobs added in April, beating expectations. However, recession concerns persist. Some firms have paused investment decisions amid policy uncertainty. We've covered some of these in the last few weeks, and key inflation measures have cooled. Still, Powell's reluctance to move rates reflects confidence that the current stance offers flexibility. Financial markets responded with measured optimism to the Fed news yesterday. Jason Pride, Chief of Investment Strategy at Glenmaid, said the Fed's path, quote, is conditional on whether the stag or the inflation emerges as the bigger risk, end quote. For now, Powell appears to be charting a middle course between conflicting pressures. And the tariffs appear, at least for now, here to stay. As Trump reiterated on Wednesday, he has no intention of easing tariffs on China. Markets now brace for further volatility. We are certainly going through massive historical change. If you want to be on top of the most up-to-date analysis on these incredible developments as they happen in this changing world, make sure you're subscribed to Market Update, hit the bell notification icon, and you will be. And if you're getting some value from today's episode of Market Update, don't forget to hit the like button. And finally for today, we move now to Europe. The United Kingdom and India, returning to India, have concluded a benchmark free trade agreement that slashes tariffs on a wide range of goods, including cosmetics, automobiles, and alcoholic beverages, marking a significant pivot by both nations toward deeper bilateral economic cooperation in the face of rising global protectionism. Announced on Tuesday by UK Prime Minister Sir Keir Starmer and Indian Prime Minister Modi, the deal is the UK's first consequential trade pact since leaving the European Union, and India's first such agreement with a European economy. It follows more than 3 years of negotiations spanning 4 British Prime Ministers. As we will see, the economic impact will be quite modest. It acts more as a political symbol than anything else. The pact aims to strengthen a trading relationship currently worth £42 billion, $57 billion, and both leaders have cast it as a strategic response to the upheaval caused by the current global trade reset. Key provisions include the halving of whiskey and gin tariffs from 150% to 75%, with a reduction to 40% over the next decade. Tariffs on UK vehicles, currently at 100%, will fall to 10% under a quota system. In return, India has secured reductions on 99% of tariff lines for its exporters to the UK and gained access to services markets, including IT and government procurement contracts. Both countries have agreed to avoid double pension taxation for workers staying fewer than 3 years. Based on 2022 trade, the deal would involve India cutting tariffs worth more than £400 million a year when the agreement comes into force, rising to just under £1 billion after 10 years. That is according to the UK government. It added that it expected the deal to increase UK GDP by £4.8 billion in the long run. Bloomberg Economics estimates it may add just 0.1% to UK GDP over the long run, a very modest increase. Indian consumers will benefit from cheaper access to British goods such as medical devices, chocolate, lamb, and aerospace products, while British buyers will see lower prices on Indian-made food, footwear, and clothing. The agreement represents a rare win for UK's trade policy post-Brexit. It follows deals with Australia and New Zealand. For India, which overtook the UK as the world's fifth largest economy in 2021, it enhances its appeal as a manufacturing and investment alternative to China amid ongoing geopolitical tensions, which we covered at the beginning of today's episode. However, the deal is not without domestic controversy. UK opposition figures criticised an exemption from national insurance payments for Indian workers, arguing it puts British employees at a disadvantage. Business Secretary Jonathan Reynolds countered that the measure was reciprocal and aligned with agreements the UK holds with other countries. Meanwhile, the UK is also closing in on a trade pact with the US that it hopes will mitigate the impact of Trump's tariffs by allowing lower levies for British car and steel exports. Concessions to Washington could include movement on the UK's digital services tax and tariff cuts on US agricultural products. As the UK-based Financial Times points out, however, quote, London's leverage, however, is minimal. Britain, for example, is the top buyer of just a tiny number of American products, such as railway cars and wooden barrels, that represent just 0.4% of total US goods exports. End quote. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Thursday, and I will see you for another episode of Market Update in a few days.